Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers. Today's presentation is more for everybody, be it clients, wealth professionals, or even those of you out there listening in YouTube or LinkedIn land. And this episode is titled, Be Careful with Joint Tenancy. Now you may be asking, Griffin, I've been watching these and you covered briefly the joint tenancy issue back in episode 18, and you're correct. I covered it in the context of beneficiary designations in general and how those types of things could override your estate plan. But today we're going to dive into more of the pitfalls specifically involved with a form of titling property called joint tenancy or joint tenancy with right of survivorship. So it is possible for two or more people to own one piece of property. And there's two forms of property ownership commonly recognized. You can have joint tenancy or tenancy in common. You also have tenancy by the entirety and community property, which we won't get into in today's discussion, other than some brief mentions later on when we look at spousal ownership. But joint tenancy can be between anybody, whether they're spouses or not spouses. But the significance of joint tenancy with right of survivorship is that upon your death, you don't control where your interest in that property goes. Instead, if there's any other joint tenants alive at your death, your property interest will pass equally to those surviving joint tenants. Now, I briefly mentioned this in episode 18, but this survivorship feature overrides your will and any trust that you have so long as any joint tenant outlives you. So, joint tenancy is often cited as a way to easily avoid probate, but it comes at a cost because it can affect your estate plan, which kind of diverts assets to people who might not have otherwise been expected to receive them, and creates unequal shares of your estate for children and other heirs. And it can also have adverse effects on the tax picture for both you and your heirs, and on creditor protection with respect to the joint asset itself. And we'll contrast that with tenant and common ownership, which is the default ownership for most co-owners of property. So, in order to have a joint tenancy, your deeds or account records have to specifically say joint tenants or jointly or joint tenants with right of survivorship, or this acronym you see down here, JTWROS. If you don't see that on your title, you don't need to worry because this form of property ownership doesn't apply. In that case, you have a tenancy in common, and what that means is that your fractional ownership interest will be passed under your will or your revocable trust. Now, by no means is this lecture designed to cover all of the issues with joint tenancy. I'm just going to kind of hit some high points that you might want to consider in dealing with titling assets. So I want to start with bank accounts. Now, where I often see clients get into trouble with this is in a situation where, for example, a parent wants to add a child maybe as a co-signer on a bank or an investment account. But you have to be very careful in how you word this because the bank may misinterpret this to mean that the child should be added as a joint tenant to the account. Now, I've seen many probates come through where there is an account that is set up this way, and it affects the estate plan because the child who's on the account as a joint tenant and not as simply a co-signer will get the account upon their parent's death. Now, this can lead to estate litigation and additional expense, especially if you have a lot of heirs who don't like that and want to fight the joint tenancy designation. It can also cause some economic issues. For one, the child now as a joint tenant has the ability to drain the account at will, which can leave few or no funds there for the parent who added the child. And additionally, if the child is sued, the child's interest in the account could go to that child's creditors. So that could cause an issue as well. And as we're going to see on a later slide, there could be gift and estate tax issues. So we looked at bank accounts specifically in the context of a child who owns it, but with real estate and other assets, it often makes sense to add a spouse as a joint tenant. And this is, a pretty easy way, and it makes a lot of sense to plan your estate and to make sure there's a seamless transition of assets to a spouse upon death. However, it's important to note that if you die and the spouse remarries, the spouse is now the sole owner of these assets. So what that means is that the assets could end up going on to a new family. So Using joint tenancy means that you, if you're the first spouse to die, lose all control over what happens to your one half ownership in that property. Additionally, if a spouse sells assets, only one half of each asset gets a step up in basis at your death, unless the asset is community property, which is a separate issue. We'll briefly discuss that in a second. And it's also important to note that during life, the creditors of one spouse may be able to seize all of the joint assets for payment, and this could be avoided with a form of property ownership that's not available in every state called tenancy by the entirety. And if a child is added as joint tenant, this could cause gift and estate tax issues as well, which we'll look at on the next slide. Now, this can be avoided through a lot of things, but trust planning is an important one. For example, if you put assets into a marital trust for the benefit of the surviving spouse, that could avoid a new family getting those assets in the event of a remarriage. And also, it could create a little bit of added creditor protection and asset management for those assets. It's also important to note that with community property and tenancy by the entirety, those have some tax and creditor protection benefits. Those forms of property ownership aren't available in Colorado, but are available in other states, and may be elective even if you don't live in those other states. I'm going to cite Tennessee because I can practice law there, and Tennessee actually offers a community property trust or a tenancy by the entirety trust, which is available to even people who are not residents of Tennessee, so long as a trustee in Tennessee manages the trust. So in exchange for giving up some control of the asset to the trustee, you could get some of these added tax and creditor protection benefits as well. Now finally, I mentioned tax issues, and more often you see these pop up with a non-spouse who is added as a joint tenant, because if you add a spouse, you get the benefit of a marital deduction for gift and estate tax purposes. But if a non-spouse is added as a joint tenant, for one, there's a gift tax liability if the value of the joint tenant interest going to that non-spouse exceeds $15,000. There's also an issue that a new joint tenant will have income tax liability for their share of income from the property each year. So if you add a 50% owner to property, well, guess what? They now have to report 50% of that income on their income tax return. And importantly, too, at the death of the original owner, the gifted joint tenant interest could end up being subject to estate tax. Now, this is minus any proportion of contributions that a non-spouse joint tenant might put in. And this is largely because ownership under joint tenancy must be equal. So, the gifted percentage of the joint tenancy interest will be included in the gross estate for estate tax purposes. But a trade-off is that it also gets a step up in basis. So, even though a parent might die only owning 50% of property if they added a child as a joint tenant, then they could get a full step up in basis for 100% of that property. Now, importantly, if the child contributed anything to the purchase of an asset or funding an account or anything, then the percent ownership that they contributed to won't be included in the parent's gross estate for estate tax purposes, but also will not get a step up in income tax basis. So that's just a few of the pitfalls that can arise with joint tenancy ownership, but in any situation where joint tenancy is contemplated, it's important to be aware of the pitfalls that are inherent in this form of property ownership. As always, if you have questions or topic suggestions for future episodes of the 10th of an Hour, you can email those to me at griffin.bridgers@gmail.com. Thank you for listening to this episode, and I look forward to seeing you in the next one.